the amount of money that you're earning now, whatever amount of money that you're playing with now, right, will probably look very small in the grander scheme of things. I think maybe you can also chime in later on, like when you're in your early 20s, the amount of money you're managing, I think compared to now, you'll be thinking, ayo, that time is like, it's like play money. It's not very big. So if you adopt that mindset, right, now I think the focus here should be harnessing the skill set and the ability to weather down like drawdowns, know how to play the game. And even if you misstep, right, when you're younger, you have a much longer runway to recover.
Have you ever lost money before?
A lot.
Why do you decide to do like finance content?
So actually it started out quite interesting. So I started out quite early on when you talk about investing. I recounted back just now. I think I started around, I guess, when I was in army. So that was roughly 18, 19 years old. So I think before that, I really had my dad to thank because it was under the influence of him. He was telling me that, oh, you must invest. If you don't invest, inflation is gonna I guess erode your purchasing power, etc., etc. So I think since really, really young, I was being inbuilt this whole idea of I must make my money work harder for me. So that was the starting. So then I started out investing. I couldn't start out investing because I believe there was an age kind of requirement back then. And back then the brokerage firm was very expensive. I think it was like $25 per trade. And I was starting out with a capital of like, I don't know, 5K, 10K. So what happened was that my dad offered me a very, very lucrative deal. So he was like saying, I still remember my first stock. My first stock was Capo Corp. So I'm not too sure you guys know, but it's basically an oil refinery company. It was one of the blue chips in Singapore. So he was telling me, hey, I'm buying, I don't know, let's say 10 lots. So 10 lots is around, I think back then was still 1,000 shares. So it's quite expensive, like to enter one lot. So he was telling me, hey, if you're interested, you want to buy one with me, I sell you one, I help you offset your brokerage fee. So you're basically just buying it at a cost price. So I was thinking, I mean, the money was in the bank anyway. Then it was like all the ang pao money. And I sometimes even throw in my own additional because I work on the side and stuff. So I was like thinking, okay, sounds great. Then I just bought in. So that was also back then, I had the first taste of dividends. So that dividend coming free money, passive income. That's what they said. So at a very young age, I was exposed to this whole concept and idea.
How old were you back then?
Wow, this is a great question. I think I was in secondary school, JC.
Wow.
Around there.
Okay.
Yeah, I started. Because that was the age requirement back then. Then after that, you pivot over, then all is history. But back to your question on how I started content, right? So I think from a very young age, I was very interested and very into this whole finance, how the global system works. And I believe it was during the lockdown period, 2020. Then there was this advent and proliferation of this whole personal finance space. So then I was looking at a lot of the consuming a lot of content, but I'm not necessarily in the personal finance space. So actually in Singapore, there was a lot of like personal finance YouTuber talk about CPF, credit card and whatnot. But I was not very into that space because maybe number one, I was not working back then. And then CPF was I think housing was also a thing that I couldn't really relate. But I was very into equities. So meaning like individual stock analysis and looking into businesses, how to look at balance sheet and whatnot. So I think back in 2019, 2020, that period, it was all Angmos. So it was basically all Caucasians, whether it's from US, Canada. And I think the biggest Asian one, Chinese one is Adam. So Adam Khoo. So he was the only one and he was like the trailblazer. But other than that, I don't see anyone else. So I was thinking, actually, how hard can it be? I believe, or I think that I can talk. I think that I think concurrently back then when I started YouTube, I was doing my finance degree. So I kind of know I had a fundamental kind of understanding from all this finance concept. I was talking to my professors. I sometimes even email some questions that I don't know before I make a video and stuff like that. So I had access to so many resources. I was like thinking, why not? So that's when I started recording and started talking about individual stocks.
Right. So it's been 4 years.
3 years plus.
3 years plus.
3 years plus.
That you started your YouTube channel.
Yes, correct. 3 years plus.
And what is your methodology when it comes to like equity investing? Like there are school of thoughts like value investor,
right?
Technical analysis. Like what is your methodology?
I think up to this point, the short answer is I don't know. Because the whole concept of like a lot of discussions, if you want to be a lot more nuanced, right? When you talk about value investing, growth investing, I do subscribe to this idea from Charlie Munger, RIP, but I think he said that all intelligent investing is value investing. Because if you go to the core and the heart of the concept, right, what you're basically doing is you want to buy when it's undervalued, and then you let it appreciate in value, and then if it's very overvalued, you sell. So regardless whether is it growth or whether is it value investing or factor investing, dividend investing, there are so many different ways of how they want to do this type of genres, right? I feel like they have lost its purpose because it becomes a marketing term. Like, I'm selling you a dividend fund, I'm selling you a growth fund. But at the end of the day, everything is value investing to me. I think in a traditional sense, people talk about value investing, right? They say that, oh, you want to buy companies that are cheap. You want to look for companies that have low price to book, price to earnings. Maybe we'll explain a little bit more later on. But in general terms, you just want to buy something that's very cheap and then wait for it to appreciate in value and then you sell. So that's the traditional value investing. But actually, if you look at the whole equation, right, when I tell you that, let's say this stock price or this meal here, let's say it's $5, it's worth $5 today. How do you know it's cheap or expensive? It depends on what's the intrinsic value that you derive from this. Maybe this is not a good example, but going back to maybe a company that produces cash flow, a company that produces profit. You tell me that the company today trades at $10 stock price. I don't know whether is it cheap or expensive. I need to look at its future prospects, how much it's growing, what's the margins. So you take all this into account, then you can come out, like, I wouldn't say accurately, but at least you know aga what's the value of this company. So then it goes back down to actually growth is one part of how you do the approach on how you determine the value. So that's why I don't really know what does that question mean anymore. But I think over the years when I talk to more people, I think I do identify as buying into uncertainty. Uncertainty is when the stock price crash, when there's some maybe impacts in the short term that I think will not be a very structural problem in the future. So I guess in a way you can categorize me under the value investing camp. So yeah, but that has been, until today, I still don't know what it actually means because I can't get a very satisfactory answer.
Right.
Yeah.
So if you were to describe your investing methodology in one word, what would that be?
Buying it cheap.
Buying cheap. That means
I want to see value. Yes, correct. I want to know where I do think that there's this quote from Buffett, right? He said that he rather buys a quality company at a fair price than a fair company at a wonderful price. But the second part is buying a fair company at a wonderful price, not buying a fair company at any price. So I think there is still this concept of cost or the pricing or the valuation of this company they need to take into account. But albeit, I think there is a lot of consideration now, like in the AI bubble. I won't call it AI bubble, but in this whole AI craze and wave, right? Companies like NVIDIA, companies like TSMC, everybody is just going up and up and up. Like there's no tomorrow. This is the best. Like this is the next best thing after sliced bread. But I remain relatively conservative on that. But we can discuss further later whether is it a bubble or not. But yeah, that's how I look at investing as a philosophy.
So would you name yourself as somebody that's always hunting for opportunities? Like,
I would, yes. I think it's part of the process. If you are an active investor, meaning you pick stocks, you are not passively investing, you are always talking to people, running your screeners, looking at different opportunities and try to build your conviction and build your position along the way.
Right.
Yeah.
Share with us, how do you hunt for which stock to invest in?
Actually, this is a lot more of an art. I don't think it's a science. So sure, you can. I do have a process where you go through a screener. So what you basically do is you look at a few factors that you take a look out for, and then you just run the screener. That's one way. I don't really use it often anymore because I get more information as I grow. Like when I grow my network, I grow more people that I know of. Usually a lot of ideas get pitched my way, whether it's in the comments below or even a friend of a friend, and then they tell me that, so give you an example, this recent company, a friend pitched to me, I think, not financial advice, and I'm not invested, but there's this very interesting Canadian company, I think it's called Fairfax Corporation. So it's basically something like a mini Berkshire. To not go too much into the details, but I think this is just how I generate ideas in a way where people just keep telling me of different opportunities, and then I go and investigate further, and then you build my conviction from there. Because I do believe that you can't borrow it. So somebody can tell you that this is the next best thing, but does not mean that when it continues depreciating, if you don't know the true value, you don't know the business, you don't know how it actually holds the value, then I think it's quite meaningless. Because especially I think everybody has a plan, right? Then until you get punched, then you realize that, hey, my plan is not worth it. So not well thought out of. So that's why I think the whole idea of value is one important piece, but I think conviction sometimes is quite underscored. Yeah. So you need to really do your homework and to know what you basically own in a portfolio of stocks.
So like when an idea gets pitched to you, for
Right.
example, like this Fairfax
yes.
corporation, right?
Yes.
So when you first hear this, I mean like and of course like a lot of people, perhaps like friends will tell me, hey, take a look at this, you know, take a look at that.
Yes.
And maybe a lot of people out of busyness don't want to do their homework, right? So what is the level of homework that you usually do, like before you really put your money into it?
I think it ranges. So ranges meaning, I think it depends on like some, in Chinese they call 冷门, means it's not very popular companies, and then there are very popular companies like your Mac 7, your Google, your Meta and stuff. So I think even as a consumer point of view, if all these large giant cap, you don't really need to do a lot of understanding in how they do their businesses. Simply put, I think Meta, Google, then the ads business. How they make money, they monetize attention. They funnel the attention into their platform, and then they create a ad infrastructure. Then they make sure that they can do relatively well to do a ROI or ROAS on the merchants. So those are the few stakeholders. But I think when you go deeper into these more unpopular stocks, then that's when due diligence really is very important. Usually my own methodology, I'm not saying this is the right way to do it, but if I'm really interested in a company after preliminary understanding, right, I'll just dip in my toe and put in maybe like $1,000-$2,000 to see this. You know that if you don't have skin in the game, you won't bother. You'll be like, I'm too busy, I have family time and whatnot. So it's only when you have skin in the game, then maybe when they report their earnings, and then quarterly you try to monitor, you try to project out, fix into some models, then that's when you have skin in the game and to realize the potential or to follow and build your conviction. But if not, I think if you were to compare it to, let's say those bigger ones, maybe I think back then, 2022 bear market in the US, Meta, Amazon, Google, just buy. As in, I'm not saying to just buy, but my mentality back then was you just do a simple valuation. You realize that, hey, everybody's just throwing out all these stocks. They were down like, I don't know, 20, 30, 40%. I mean, why not, right? So, and then after that, you see that they have been recovering quite rapidly over the last 1.5 years. So yeah, that I think it varies lah. There's no outright
hard and fast
formula,
rule.
correct?
Right. So will you say like up to this stage, probably about 3 years into like creating your channel, are there moments that you use gut feel to invest?
Actually, no. Gut feel meaning
like you feel that this is a good opportunity, and then like
I think at the bare minimum, I'll try to figure out the valuation. Meaning, at least as simple as it is, it's a 10-15 minute exercise. Right. You try to put it in, to try to do some projection, to look at what your expectations are. If not, I'll probably never, like, if a friend pitched to me a stock and then say, oh, I trust you, that's why I'll just buy the stock. I think I've not yet went there. But maybe have you personally been?
No, I don't do stocks now.
Oh,
yeah, so I mean, I used to in the past. I do mostly real estate.
Okay.
Yeah, but of course, real estate, we have our own set of like methodology. We call it the moat analysis. Yeah. We have like 10 points that we try to check off, and then we look at disparity, effect pricing, and all that. So in real estate, like popularity of the project is important, because the volume is important. For example, like if you look at equities, I believe the popularity of the stock is also important, because if there's no trading volume, no volatility for you to take opportunities, then it could be a stagnated stock. So would you say that the brand of the company is important, like the popularity of it is important?
I think it depends on your time frame here. So what you're basically talking about, right? If I can summarize it into one word, it's probably called momentum. So momentum investing is also one genre of investing style. Right. But I think when you go back down to the focus of like, if you do believe that in the short run, right? I think prices can be anywhere. Like, whether is it because of momentum, because of what other reasons or factors out there. But I do believe that if I do adopt a very long-term horizon, meaning I do 20 years, 30 years, right? Then the value of the business should be or the market should be a weighing machine. Meaning I will really know what's the value of this business, because it should reflect maybe the dividends they're gonna get back, the share buyback that the company is gonna acquire back their shares and stuff. So in the short run, yes, I do agree that it's very important, because especially if you play with technical indicators and whatnot. But in the long run, I think it's not so much, because emperors not wearing their clothes will be shown, because I do believe will be exposed, because market is a price discovery mechanism. Meaning in the long run, you will definitely know whether this company is a good one or not. But it's just that sometimes in the short run, you don't really know what's going on.
Right.
Yeah.
How much do you think should a person be invested? I mean, like in equities, like what do you usually advise your audiences, or maybe start off with like how heavily are you invested? Like what percentage of
100%
into equities?
Okay, so I think very important caveat here is that everybody has very different life cycle, right? So at the start of my life cycle, meaning I think back then I was also termed as or coined as quite risky. So I think when I started YouTube, that was in 2021. 2021, how old was I? I was shucks.
How are you now?
I'm 26.
Oh, okay. That was 23, yeah.
Oh yes, I'm 23, correct, 23. So I didn't have a very stable, I was still studying. So then I was creating, then a few of the videos when I guess they got a bit more views than the normal one because everybody see all in, right? And they'll be like, wow, this guy all in into one
you put
stock.
like the title as all in.
Yeah, I put everything into one stock specifically.
Okay. What were the stocks that you went all in before?
Actually, I only went into all in one stock before. It's Alibaba. So it's a Chinese tech. I mean, the Hong Kong market, we can talk about it later, but I kind of built a niche in that space where a lot of people will, not a lot of people are talking about the Chinese tech market. Because it was a bear market, there was huge drawdowns, and I think even until now, not so many people are interested. But anyway, I think back to the question on allocation, right? I don't really like to hold cash. I think it was a propaganda spread by my dad also that he keeps telling me cash is not good. He doesn't really like to hold cash as well. So from young, I've been in the perception that I don't like to hold cash, and I like to invest. So even until today, I hold maximum 6 months in like expenses.
Right.
And then the rest I'll put it in the brokerage firm because I know that sometimes I might not be able to control myself. So then I would spend the money. So everything I just transfer to the brokerage account first, then we talk later. Whether the money is invested or not, that's a different topic. But I'll just transfer everything in. And then considering the life cycle as well, I think it's a little bit too early for me to invest maybe in a property because of the huge quantum back then as well. Then I was not really a very big crypto fan as well. So I don't really have crypto exposure as well. So it was everything in equities. So even until now, if you ask me like my entire net worth breakdown, I would tell you that I'm mostly invested. So I'm probably 90% in equities, 10% in cash, and nothing else. I mean, I recently got my BTO, but that's a 5 years thing later. So yeah, I'm still a huge advocate of equities. But I think when you look at the different profiles and people, especially when you spread this video out and then you get people of very different walks of life, right? That's definitely not advisable. The textbook answer that I can give you is please do a proper diversification, property, stocks, and bonds portfolio. I mean, if you want to carve out the property, that's one part. Then I think the traditional terms is like 60-40, right? 60 equities, 40% bond. But I think really in your earlier years, when you're younger,
you can take more risk.
I would say don't bother. Yeah, don't bother with bonds now, especially when in Singapore you have the CPF system. It is like a bond. It's acting like a 4% or 2.5% bond, like accrual. So don't waste too much time there. Look into your time horizon, your risk profile. But the risk profile thing, I think it's important because some people, they hold a 20-30% drawdown, they want to give up. So I think the best investment strategy is actually one that you can hold through, like really hold through. Not say only now, market all time high, you say I can hold 10, 20, 30%. When it tanks already, then you'll really know whether you can hold through 20, 30% or not. So
it's like a bit of like a mental game also, right?
Correct.
When you say that you're like 90% into equities, 10% into cash, and then of course from your dad's influence, you feel that you don't want to hold cash.
Yes.
What is this notion about not holding cash in relation to like our purchasing power being eroded by inflation and all that? Like, what is your thinking behind this?
I think there are two parts to this. So the first part is like you said, right? Because even if, let's say the inflation rate is at 4%, so every year you are losing 4% in purchasing power. And there is the idea of opportunity cost, meaning if you put it in FD, maybe they give you 2-3% today. If you put it in equities, hopefully in the long term, it should return you that X amount of hurdle rate that you look at. But I think the second part really is when I look at my current life cycle, right? The amount of money that you're earning now, I mean, hopefully that you're an enterprising young man, you continue working on your skill set, then you develop your ability to earn more money in the future. So whatever amount of money that you're playing with now, right, will probably look very small in the grander scheme of things. I think maybe you can also chime in later on, like when you're in your early 20s, the amount of money you're managing, I don't know how much is it, but I think compared to now, you'll be thinking, ayo, that time is like playing 半家家酒 like that. It's like play money. It's not very big. So if you adopt that mindset, right? So now I think the focus here should be harnessing the skill set and the ability to weather down like drawdowns, know how to play the game. And even if you misstep, right, when you're younger, you have a much longer runway to recover. I also very afraid that people take the wrong lesson from this, saying that, from young means I can all in crypto, degen, I have 0 date to expiry options and just throw everything. But I do think that it's a phase of exploration, and it's a phase for you to make all the mistakes you can, so that in future you get that. You don't make mistakes when you have multi-million-dollar portfolio. I think it's very different when you're managing 5-figure, 6-figure, and then goes into 7-figure, 8-figure. I think it's a different mentality. But I do really believe in the mindset that if you don't even put in, let's say, $5,000, $10,000 today, next time you got 5 million, 10 million, you won't invest one. You will think that sometimes when people don't have the money, right, they think that it's a rich person scheme. But really, when you reach already, right, then maybe you derive it from income, right? Then I do know of a lot of people, I do meet a lot of business people, right? They just continue working at their income. And I'm not saying that's not good. It's good, but I think there is a cap, because when capital plays into a capital feed capital game, it's definitely faster than when you try to trade your time or skill set with income. And I'm not saying that I've already reached there, but I'm just saying this is my own analysis of how I look at things since young.
Right.
So yeah, that's generally how I look at.
Right. How about the second part? Like what's the debt's methodology, like why you should not keep cash?
Why he should actually no, like when he gets older already, right? His methodology starts to change already. Okay. So he teaches me when he was probably younger. Then now, because he's already retired, I think he retired quite early on.
He's in his defensive stage.
Yeah, he's in defensive stage already. Right. So he plays a lot of dividend plays, and I think through the different life cycle, you will adjust your investment philosophy. Whether is it because of life circumstances or whatnot. So yeah, lor.
How many seasons do you think there are in the investor's life cycle based on their age?
I would like to believe it's only one. If you're able to invest like Buffett, even at 90 plus years old, he all in Berkshire Hathaway, he manages the whole portfolio in Berkshire. But I think that if we come down to human level, meaning we are normal people, we are not at Buffett's level, right? I do think that there is a growth stage, which is when you're accumulating capital, and then there's a drawdown stage, which is when you need passive income, you need dividends and whatnot. So that's generally how I look at things for now. Yeah.
And do you think our cash is being eroded away on a year-to-year basis?
I think unless you're in like China today or you're in Japan for the last 20 years when there's deflation, I think it's normal to think that inflation will keep eroding it away. But I think there's one caveat here that we need to put in is when you need cash for optionality, meaning today you want to leave your job or you want to start a business, or when asset prices, there's a black swan event and then the whole market comes down. Then that's when cash is good, because suddenly your asset prices become very low. The same amount of cash can buy in a lot of assets. But how I look at cash is really just a vehicle for you to acquire more assets. That's all. That will benefit you hopefully in the very long run.
Right.
Yeah.
Have you ever lost money before?
A lot. Lost money in terms of my investing?
Yes.
I think the funny thing is, so I was invested in the Hong Kong market, right, when I started out. And that was when I had the first taste of really big drawdowns. So initially, I think when I started out, I was in a very sheltered environment. Singapore market, like Magic Cup like that, like won't move one. So it tries to hold there and then it's just struggling there. But the dividends are good. Yeah, it's a dividend play. There was recently this interesting discussion about STI being a super terrible index. Then recently STI breaks out again because of the interest rate and whatnot. So all the REITs and the banks are rallying. So then it becomes suddenly a super terrific index. But that's a discussion another time. But I think back then in Singapore, I think stock price was okay. I bought into Keppel. I was in DBS as well in the very early days, but I all sold out. I went to the US market. I bought big names, Microsoft, Apple, and stuff. So I didn't really have my big drawdown yet until I went to the Hong Kong market. So
which year was that?
Very late 2020, start 2021.
Oh, okay.
So I think back then I still remember. So my first stock was Alibaba, right? So I think Baba was at the peak of like 310, 320. Then it drew down to 30%. So it was 220. But of course, I mean, in hindsight bias, we know that the whole tech crackdown dragged for very long, and then the Chinese economy is under some very strong structural changes. So those are because hindsight bias. But I think when you drag it out, right, I started entering the first position was around 220 or 240. Then it went all the way down to 60. But I've been averaging down all the way. So even until today, after holding for three years plus, I'm still underwater on that particular position.
How much is it now?
I think it's 80 plus.
Right.
80 plus. So, of course, then you can say that I did it because of content. And by the way, I got kind of, I wouldn't say, I got a bit more popularity of people following me because of this whole drawdown, like this whole Chinese tech drawdown. Everyone was saying, what's going on? Can buy or not? Blah, 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 and stuff like that. So I think when I go to some of the financial creator events, people will say, oh, you're the Baba Boo or you're the Chinese tech boo. Right. So that was the niche that I kind of carved out. But I think the Chinese tech play now, I'm only in 2 positions. So I'm in Baba and Tencent. So Tencent, I was very lucky because I always didn't buy Tencent because of valuation concerns. They were priced, even after the crackdown, they were still priced quite high. Then I still remember very fondly that in 2022 October, that was when the election that we had in China. I mean, it's not an election when everybody votes 100% of the vote. But anyway, they had the election, and then Xi had an unprecedented third term because over the years, it was always two terms. Then they had this meritocracy, and then they changed the president. But Xi did a lot of changes, and then he went in for the third term. And I still remember back then, right, on that day of the announcement, all the mainstream news article was writing how China has lost its way, blah, blah, blah. Everything was selling down. Then that was when I took the opportunity to continue averaging into Tencent and Baba both. So Tencent, I think back then, I had a very small position. I entered a larger one in the election, that period. Then I think it doubled from there really. So I think net, if you were to count my plays, right, in so Chinese tech, up. Yeah, I wouldn't say balance because Baba is still a very big position, but it kind of offset and subsidized a bit. So yeah, we'll see, but I really do take a very long-term view when I go into positions that I want to hold very, very long-term. Like I'm not here to trade in, out, 20-30% I'm out. If not, I would have exited a lot of my positions really.
Right.
Yeah.
So now you're only into these 2 positions?
No, so those are for my Chinese tech positions.
Right. You have other positions in US and all that.
Yeah. China, I actually played a bit. I was trading the banks as well. So China banks was also, full disclosure, I didn't really know. Hey, actually, if you want to go back to the idea of trading momentum or trading macro, right? I think I was trading macro on China banks and I also have Haidilao. So those are my Chinese position. Then in the US, I have 3 of your Max 7. And yeah, a few stocks here and there. But I still run a very concentrated portfolio in a way where it's no less than, I think, 15 positions. But I think the top 4 or 5 positions make up like 60-70% of the portfolio. So it's very, very concentrated.
I see.
Yeah.
Why are you big on China?
Why? That's a very loaded question. But actually, I come prepared. If you don't mind though.
Yeah, sure.
I think I just wanted to give the context, right?
Yeah.
Because it's important to know. I'll refer to my iPad if you...
Yeah.
So,
go ahead.
I think it's a loaded question because maybe for the international audience that follow me, right? For those that really like China, they will love China because it's cheap, the great economic growth story, it's a miracle, whatnot. For those that really hate them, they really hate them. They condemn them. They say that it's a lost cause and whatnot. I think I'm somewhere in between, but I'm more optimistic or more hopeful about the whole recovery story. So I recently came across, or at least just yesterday, GIC and Bridgewater, which is founded by Ray Dalio. They did an interview and they posted the interview online. Encourage all of you to go and check it out. But they talk in very financial jargons, meaning not normal people can understand one. So I try to break it down to let you all understand a little bit more.
Right.
So when we take a step back and to understand how China has been doing, right, it has been a miracle or has been a great growth story when you compare it to other developing nations. So just a few numbers. They grew from 2000 to 2010 around 10.4% in terms of GDP growth per annum. So you think, and that was largely brought about because of the WTO entry. That's why they built their whole, export infrastructure. Then after in 2011 to 2019, it moderated, but still quite respectable growth, like 7.3%. Then it's only the last 4 years, right, when there's this whole property deleveraging, this whole crackdown in a lot of their tech sectors, in their ad tech, people are not giving birth, the marriages are also going down. It was a confluence of many factors. And then the growth rate dropped to 4.7% on average over the last 4 years. So you can be a half full guy or half empty guy when you look at the cup of China today. But don't forget, China is still a very big cup. You can't run away from Chinese, the whole economy itself. Whether it's from a consumer point of view or a business point of view, Apple, Tesla, everybody has factories there. You want to think, you think that you can try to silo your portfolio. I think it's quite hard. But I think there is an important, I guess, caveat here is that when you look at what is being priced into asset prices today, I think it's quite dirt cheap. So a few, like based on the time of this recording, right? So the Hang Seng is down 48% from its all-time high from 2018. So it's at around 17,400 points now. Similarly, the CSI 300, which is another index that tracks the top 300, is basically the Taobao version of S&P 500. You know, S&P tracks 500 largest. CSI tracks 300 largest in China. It's also down roughly 47% from its all-time highs from 2021. And A50 index is also another blend of top 50 companies, only A shares denominated. They're down 50% from the 2021 highs. I think it's quite hard to imagine that even maybe a country like Japan that went through the 20 years lost decade, they're breaking all-time highs today. So if you are buying into okay, maybe Russia is the exception that maybe they're still in the war now. But don't ring the bell too early that you can't make money from Russia equities. Of course, you might need to skirt through some of these regulations on how you own them. But whenever there is a bear market, whenever expectations are low, I do think that there's this phrase, right? They throw the baby out together with the bathwater. You need to really understand in a deeper depth on what you're buying, how the companies are making money, regardless of the macro condition. And because of this huge bear market drawdown, everybody just throw everything. International investors don't want anything to do with China. There's a lot of like geopolitics, a lot of posturing and stuff. So at least for myself, I do think that I try to be optimistic when in times of this kind of adversity. But of course, I do a lot more due diligence specific to the companies. Maybe we can expand a little bit more later. But I think now the bigger macro concern today, if you try to pinpoint right into looking in China, is really the deflation expectation. I think that's something important. You look at it, I think from the GIC presentation as well, is there's two types of scenario. One is you try to clamp down early in terms of deleveraging and then quickly try to resuscitate the whole economy as a whole. On the flip side is when you do too much too late. It's when consumer expectations are already there and then people start to want to spend money and then they think that all their asset prices are being deflated. It's basically the Japan classic case study where they went through that whole very painful 20 years. So now, I think as a prospective investor or even as a current investor, you don't know where they're at. So China is not here, not there. You look at the policy stance, they're also not really bothered about it. And then they say that they like control, they like safety. But yeah, at the same time, they're not trying to save the economy to a very large extent, meaning like to do those helicopter stimulus, just throw money like what they did or what the world did in 2020. So in fact, they are looking more so in trying to clean up their balance sheet, try to deleverage the economy, which is very counterintuitive. But on a personal finance level, I can understand why China is doing that. But on a global macro level, I don't know whether a lot of people will agree with what they do. But I think when you try to, that's the difference between investing in index and investing in companies, right? So looking at the companies that I own, I think when you look at Tencent and Baba today, I'm sure there are competitive pressures coming from a lot of places, but they are the baseline infrastructure of the Chinese existence today. WeChat is, if you go to China before, WeChat cannot be gone. WeChat Pay, Alipay, Taobao, everything is there. They basically own the infrastructure. And I guess in a very simplistic term, if the Chinese economy slows down, they already have started slowing down. And these companies' growth has started to moderate as well. But if you really do believe in the recovery story, I think there is a huge upside to be reaped, especially with very low expectations being priced in. And in fact, I think just to throw a number, right? So the S&P, which is the US, right? They are traded roughly around 26, 27 times PE. Of course, I'm not endorsing that PE is the best metric, but it's a very simple and easy to understand indicator. Price to earnings, what's the price that they are trading at today? The earnings of the component index, and then you just divide the two. So the higher the price to earnings, the higher the so-called valuation. Because you are taking, like, let's say it's a 26 times, 27 times, you take 27 years to get back $1 of the money you invested. Of course, not discounting the growth that they can grow the earnings so that PE will compress. But I think, back to the point, so S&P today, let's say the PE as of the time of this recording is around 26, 27 times. You want to take a guess, the Hang Seng Index PE today?
What is it?
It's under 9. So it's nearly 3 times the expectations.
Wow.
So there's a lot of, I'm not discounting the exceptionalism of US. So they have strong fundamental points. They have strong...
but there's a huge disparity.
I would say a lot is being priced into the stock today. So then, and of course, I'm not saying don't buy because I also have exposure. But really, when you look at like the Chinese equities in general as an aggregate, I think they're pricing in some sort of a negative growth rate. So that has been on the index level. But when I look at the component companies, all of them are still growing 4, 5, 8, 10% easily, even in a more downturn, a more pessimistic cycle. But of course, let's hope that the numbers are not fake lah. I mean, that's a very big disclaimer that a lot of US or a lot of international viewers are scared of.
Right.
But I think for Singapore, maybe because of our majority population and we are closer here and we have Asian values, whatever you call filial piety, Confucius and whatnot, maybe we are more comfortable. So that's why I also have like quite a bit of like Singapore investors over the years they've been asking, so can buy, is it still good time to enter and stuff? I would tell them usually I wouldn't say advice but I would usually say it's a long-term horizon thing. You can't expect to flip and then, I appreciate 5-10% and then I want to exit. I think the volatility is not there. The interest is not there. So there's no point if you really just want a quick 10-20% flip. But if you're looking for multi-baggers, right, I always joke with my friends that, I do see Baba, Tencent. It's an easy double, triple bagger. Like at current valuations, meaning they don't surprise us on the upside, right? Just purely from expansion, people get excited again, capital comes back. I think it should be. I want to hedge my position, but I think it should be quite okay lah. Yeah.
Right. So like when do you start to really like understand about China? Like how much time do you spend back then? Which year was that?
I would say a lot of time. So
okay. And it's a consistent kind of thing.
Yes, it's because I need to keep track of what my companies are doing.
And that was starting from like 2021.
Before that, I think in 2020, I already got started interested in Hong Kong. But I didn't pull the trigger because they keep going up.
Right.
Then, I don't know, is it just me, like the DNA in me, the cheapskateness? I always don't like to buy when things are at all-time highs. Right. So I like to buy when I like to take advantage of opportunities when bear market or pullbacks or whatnot.
You like to buy undervalued stuff?
Yes, correct. Okay. I think it's a lifestyle. So even my phone, right? So I'm using, I bought it
2 generations before.
Yeah, correct. 2 generations before.
Okay.
So I think it's a lifestyle. So it's a philosophy, if you can put it that way.
Right.
But back to this Chinese market thing, I do spend a lot of time. Sometimes you're forced to, right? Back then, remember I was 100%, right? Into many of this, whether it's Chinese tech index or tech stock, Tencent, Baba. So also maybe the algorithm starts to, you start to curate the algorithm, and then the algorithm knows what you like and what you don't like. And then you start to get surface all both the good and bad news about it. So I take a more keen interest. I think that has been why I started to study more and more.
Right. Last year I chanced upon this book by this professor, Ke Yujing.
Okay.
It's called The China Playbook. So it's a fantastic read. It talks about demographics of China, where they're at, like how much growth and the potential for the next 20 years. In fact, she breaks down a lot like what you have been talking about, like the growth, the new generation where they are all bilingual in English and Mandarin. Their buying power. They like to loan and borrow. And of course, the huge consumer market and all that. She did talk about challenges and all that, but I think the biggest takeaway I had was that to understand about the political system and how they come down to really like drive growth and support the businesses. So it's quite amazing kind of like concept when you look at how China has evolved and then like escaping out of poverty and the amount of growth engine it has. I've been to China quite a fair bit of times. On the ground, of course, when I talk to the business owners there, they are concerned about the economy. But of course, when you look at the whole country in terms of like opportunity, I think it's a very powerful country, like in terms of not just the economy, but the drive in the human beings there is very different. Will you ever get out of this position? Or will you like just hold all the way, even like until you're 46 years old? Actually, I'll be quite curious to know. So I'm 26, right? So 20 years later. Yeah. So now it's 2024. I'm actually quite curious to know how Tencent and Baba will look like in 2050. So maybe you say getting out meaning selling everything. Maybe on a portfolio allocation perspective, there's a better opportunity, better value. Maybe we'll consider, I think, back then lah. But also then, because this is a rhetorical question, right? There's a lot of assumptions, meaning you can find a better opportunity.
You need to have better conviction as well, knowing that this new company that you just found, this new Pokemon will be better. If not, I think if there's really this whole recovery story to play out, right, and growth just start coming back, and then they suddenly become all growth stock again, and then start growing 20-30%, the valuations will be reflected. So that's not really a hard and fast rule to say I'll sell or don't sell. But I do think that, since it started on my whole YouTube journey, investing journey, right, maybe I'll just hold a small part and then see how it'll go 25 years later. Because I'm really very interested to see how it will play out when I started out as a young punk, not doing anything, and then after 30 years, I can tell people that, hey, I held a stock for 30 years. And usually, I think it's quite hard to find equity investors holding companies. Think about like all your Mac 7, like Apple, Netflix, whatever. You held for like since 2000s. Whoa, you'll be rolling in cash now, I think. Even if you invested in a very small, like 5-10K position, I think they all multiplied like don't know how many folds. But I think to be more pragmatic in a way, because I think these are really tech juggernauts. They're very big. So you need to find the next growth curve, whether it's AI, cloud, whatever it is. You'll be very surprised because I looked at the whole Netflix journey of evolution, right? From the rental space and then going to online and then all these sunsetting, going into subscription model. Don't be too surprised on how a company will transform. Like how humans transform, right? Companies will undergo a lot of transformation. And the management team is important to drive this transformation and to be able to adapt to new times. But I think circling back to what you're talking about, right? It's important because there's a lot of nuances when you compare whether it's in investing, even Singapore versus US, there's a lot of nuance. US versus China, a lot of nuance. But I think what we can be appeased about or be happy about is that I do believe there are universal principles, basically like traditional value investing, to buy when it's undervalued, to be more conservative, to stay in your circle of competence. I think all these are very sound investing advice. But then when you start layering in politics, layering in policies and stuff, then it gets a bit more complicated and complex, but you still want to keep an eye out. I think that I was recently joking about this idea where in China, regulations is inevitable. That's what they say, because they always take a very parental approach. They want to come in and to make sure that you're doing things right for stability and safeness and what. But I think in US, it's a live and let live, let you grow first, and then they'll come in to regulate you. They will try to sue you, but in the end, nothing happens. So I think it's a different climate that you're in. You have to be very aware of that. But that shouldn't deter you. Of course, if you have no interest, please don't go into stock picking. But if it's something that you're always looking out for opportunities, I think it's a good time, even after this bounce from the 2022 lows because of the election. I think a lot of these names has already bounced 50, 100%. But in the grander scheme of things, they're still down 60, 70%.
Right.
So yeah, that's my general take.
What is going to happen next year? Like with all the rate cuts that now is a hot topic, right? It's like rate cuts. I think it's like tonight, and then like the next 2 months, the next 4 quarters as well. Like, what do you think will happen to the stock market?
The interesting thing about asset prices, right, is that you don't have it's not like 10-year series, where you got the answers and then you know that what is exactly being priced in. Everything is a game of probability, right? So we are just wanting to be more right than wrong for more number of times. That's all. So when you look at this rate cut thing, right, just following the Singapore market, for example, using the REITs index or what do you follow, they've already rebounded quite a bit. And
they really priced in already.
Yeah, they've tried to front run and try to price in. We can go on at length to discuss, is it a 50 basis point, 25 basis point? How does it affect the US economy? But I think in general terms, I don't really put a lot of emphasis in macroeconomy, because I think number one, I'm not smart enough to comprehend the complex ins and outs of it. And I think in point two, I'm more a ground up investor, meaning I focus more on the businesses, like you said, like moat analysis, right? How the company has the moat to withstand, whether is it a high interest, low interest, a bad macroeconomic environment. So that's purely from my own perspective. But when you want to look at, like, if you want me to comment more on that rate cut thing, right? I look at Singapore market. I hold a few REITs position, not a big position, because it was I don't really follow the market. So I just bought in because I know that it's probably undervalued. Like everything was trading under price to book in the Singapore REITs, NAV and whatnot. I just bought. And then I just opened up today. It's a few $1,000s position. I opened up today. Everything's up like 10, 15, 20%. Then I'm like, REITs are performing better than some of my all these so-called undervalued US companies or what.
Right.
15-20% on REITs position. People talk about dividends, collect 4-5%. You already got like 4 years worth of dividends from the capital appreciation. So I look at this from a point of view where a lot of people are really trying to front run many of these expectations really. So is this still undervalued? Do you think still can buy? I hold a neutral position. I do think that even from a REITs point of view, still should be undervalued. I think this is, you shouldn't hold me on that. But if we do see a new normal, meaning 5%, last time was 0%, it jack up to 5%, I am assuming that 2 to 3% will be the new normal. Like we wouldn't go down to 0% again, because it feels like 0% feels like they're taking a jab. Like when the patient is almost dying, right? And it's an emergency measure to jab the body.
Yeah.
But we have enjoyed that low interest environment for a very long time already.
Yeah.
And people might be under the illusion that this should be the new normal. But I don't think it should come down. As in, I don't think it should come down so much. But I do think that it should come down because of that tighter condition. So 2 to 3% is the expectations. Then you slowly map out like what's the expected valuations of these REITs or these more interest rate sensitive companies.
Right.
Yeah.
So do you take what is happening in the macro market, which is like, I mean, like interest rate is one of the largest thing, because for interest rate to come down, definitely there has to be like liquidity that's being generated, right?
Right.
Yeah. So like, do you take this kind of signal as timing for what kind of stocks do you want to invest in?
I would like to think that I'm good enough to do that, but I think in the very basic answer is I don't think so. I think macro is good to know. It's good to follow so that I can have so-called educated conversations. But I think in terms of investing, how big a role it plays, actually I think not much. At least for me, for myself.
So you look at the fundamentals of the company.
Yeah, correct.
Right. Not so much on the timing.
I think you can, because likewise, right? So when interest rates keep going up, right? So you see REITs keep coming down. Like I think on the index level, it was down 20-30%. If you know that we are going to the rate hike cycle, don't go and stand in front of the train and then say that I can. But of course you can. I think in the long term, if you buy solid REIT companies, solid portfolio, they can keep raising rents. I think it's fine. But if you want to talk about you're trying to punt for the recovery or punt for that uptick, right? Then actually back then in 2023, when you already hear news of maybe a potential rate cut and talking about going to a recession, because we came out of a 2022 so-called recessionary scares. That's why the US market came down.
Yeah.
So if you know that it's really tighter economic condition and they're going to rate cut, then it was actually a good time to buy REITs. But of course, I don't have the conviction. I just bought a bit, just get a bit of exposure. But if I knew, and if I'm very confident of what, I do see people just going, really throwing kitchen sink and going all in. That they went down a bit, but it all recovered already, because it's kind of a very standardized theory where interest rate cut, interest rate sensitive stocks all go up, small cap, REITs.
The boom and bust cycle.
Yeah, the boom and bust cycle. So if you really do follow them, I would say that it plays out probably 8-9 times out of 10, but you just have to be worried about that tail end risk where what you expect sometimes might not really come true. I think that's usually the concern. That's why they advocate for diversification and be more safe in your place.
Right.
Yeah. So
is this like a full-time thing?
No. So I would identify as an investor first, then a content creator second. So I'm not full-time, but my full-time role, because I'm currently working with Adam. So I'm in Adam, I'm doing research, I'm doing content, I'm doing a bit of marketing for AK's Piranha Profits, which is his financial education business.
Right.
So I actually do have to read up, because people will ask questions and I have to come up with timely content to keep up with that content wheel, right? But I do research on I won't say full-time because it's not necessarily my full-time job. I guess you can call it part-time. And I do content on a part-time basis as well. So I just
content is your own gig, but your full-time role is at with Adam. Right.
Yes.
That's your full-time job.
Correct. It's a full-time job.
And
yes.
What do you do there? Like research and...
Yes. I summarize in 4 words. Usually some people ask me. So I read, I think, I analyze, and I write. Yeah. So basically it's a...
for the organization.
Correct. So it's basically a research role, an analyst role.
And
also
like
a content.
Yes.
Blogs. I think I'm also trying to build the YouTube channel for the company.
Okay.
Yeah. So doing more content marketing related stuff.
I think.
Yeah. But
this channel is your own thing. It's technically your own thing.
Correct. No, so there is a company channel, then there's a private channel.
I see.
Private channel under my name
is your own.
Yes.
Okay.
So the company is the company.
How do you find time to do it? Like do both, like for
I think it helps when it's complementary, meaning when you understand something, it gives you a fuller picture of the whole investment world. So that's that. But I think content publishing, whether is it from a company perspective, it's quite clear because there is a methodology the company, like you said, right, your mode analysis, it's a proprietary company point of view. And usually when I'm going to work, I go into that lens and go into that view.
Okay.
But offline, like meaning off the set or off the company premises, I adopt my own thinking, and so it kind of attracts different type of audiences. Yeah. So
do you appear on a company channel?
Yes, I do.
Right. How frequent do you create content on your own channel?
Last time I was quite aggressive. Okay. So on that growth curve, right, I wanted to ride on that spike. I think I was doing 2 to 3 times a week.
Right.
Video
now?
Content. Now I think 1 time a week, sometimes once a fortnight.
Okay.
Yeah. Right. I really scaled down quite a bit.
Okay.
Yeah. I think more so also to re-strategize and to reposition the channel.
I see.
Yeah.
I see. I mean, like throughout this process in the last 3 years, you enjoy creating content.
Yeah. Yes.
You like it?
Maybe not on the creating part, but more so, I think I like to share. You don't like to share if you're a creator because you will want to, whether is it to teach, to educate, or just to share your own journey. I think that's something very important. And I think the second part is really the doors that it opened, meaning to be able to know people, to be able to get into networks, and like to share with you an example, right? So recently I did a recent stock that I was following is Lululemon. So Lululemon, I'm not too sure you know, it's the yoga pants athleisure brand. Yeah. They had some slowdown concerns in Canada and US.
I just completed the book on one of my retreat. I mean the book that the founder wrote.
Right.
Yeah.
So then I started doing an analysis, like 1 or 2 videos in. Yeah. Then I started getting like LinkedIn messages or people working in Lululemon, connecting and asking me for my opinion. And I also asking them on how the company works and stuff like that. So I think social media, if you look at it as a very toxic place, it could be toxic. Meaning people scold you. Actually, some people recently call me fat, but I don't know how. But anyway, I think if you look at it from a negative point of view, it could be negative. But if you look at it from a positive point of view, I think I managed to connect with quite a lot of like, whether is it private investors, global people and stuff. Right. Yeah. So it gave me a better perspective. And I know that I will probably be 5 times, 10 times more worse off if I don't create content. Meaning because I made that avenue to invite people to connect, it gave me more insights than me staying as a private investor or me thinking that arrogant enough to think that I can stay in my own bubble and think that I can make good decisions without engaging with anyone.
It improves your perspective.
Yes.
Empathy level, also your network as well.
Yes.
Will you ever stop creating content?
Stop creating content? I think for now, no. I think a lot of people that followed me, I think over the years, right, it became a journey really when you see names that are quite familiar. And they slowly build the portfolio together. They were saying that, then they share their opinions and whatnot. So it becomes like I'm just bringing along a few buddies onto this trip on how big I can like grow, whether is it personal level, on a portfolio level or whatnot. But of course, a lot of people like to click in because they see big numbers and they say, this guy review portfolio, I like to click in. Right. A lot of the capo bunch, but I think there is also that
really like
tribe that is building,
really want to learn.
That want to learn and want to continue on together with you. So I think even if I were just to impact this tribe, so-called tribe, 1 people, 5 people, 10 people, I think it should be a motivating force for me to continue doing.
Right.
Yeah.
Right. Awesome. So Chi Keng, let's talk a little bit about the current FOMO now, which is like all the AI stocks, right? Yeah. What's your thoughts on it?
I'm very scared to give thoughts on this kind of thing because I learned this from Kelvin actually. Kelvin always say, let's say you put out a position, regardless whether it's bullish or bearish. Let's say you're bullish, right? Then every time the market corrects maybe 1-2%, everybody comes in a comment, you don't know what you're doing, blah blah blah. But
do you get that a lot? Like
a lot.
How do you get past it?
Chinese, right? There's this term called 眼不见为净, right? So I try to just don't engage.
Right.
Because once you engage, you'll light up fury of follow-ups. But I think I do acknowledge or I do appreciate like people giving feedback because that is how you know or how you can improve and what's your blind spots. Yeah. But anyway, sorry, I digress. But back to the point. I made a video on Piranha Profits the other time where I was talking about, so my partner, my girlfriend, right? She's not into stocks at all. So what she does traditionally, What I tell majority of the people is to just passively index every month, set aside some money, just buy, don't care up, down, just buy. Suddenly one day, she came over and asked me, hey, you know what's NVIDIA or not? Then I'm like, oh man, this is a very scary parable because that was when Buffett always say, right, when the shoe shine boy or when people are not interested in stocks, right, suddenly start talking about what's the next hottest stock. This stock can make X amount of dollars.
There's a red alert, red flag.
Yeah, this is very important also because I think back in 2021, everybody around me was talking about crypto. Everyone. Like, I'm not even joking. Even girls that are not interested in finance, right, they're talking about crypto as well. So that was the first red alarm. But of course, I didn't manage to like short or make a lot of money because I just thought that this is a very interesting movie that is playing out. I'm just an observer. But I think going back to this whole AI thing right now, I think NVIDIA is the crown prince of this whole rally. I think from their lows of 2022, they 10x, more than 10x already from the lows. So naturally, you have more traders going in, you have momentum, you have volatility, people made a lot of money, then they spread to other people. There's a lot of volume. Yeah, there's a lot of people going in. How I look at it, I look at it from two point of view. Let's say you look at it on a macro level. I think macro speaking, even though I cited the number that 26, 27 times PE, S&P, they are above the one standard deviation. So standard deviation meaning, so this is the average or the median. Then one standard deviation, they tend to calculate based on historical data and they try to price in what is the acceptable range. So usually within 1 SD is fine. 2 SD, it starts to get dangerous. 3 SD is never seen before because it's very tail end risk. So from what I understand, I saw a report recently, is we are roughly around 1.7 to 1.8 SD. You say that it's expensive. I can acknowledge and I can understand why. You say it's cheap. I don't think anybody will agree it's not cheap. But you say it's in bubble territory. I think I'll be a bit conservative to say maybe we're not in bubble. Because as we know, right, past few bubbles, right, it can go higher and higher and higher. You can call a bubble now and then you look stupid because it's 2x or 3x from here again. So I'm more skeptical in saying there's a bubble. But what I can say is we are probably above average and we are slightly on the hotter scale. But that's about it. NVIDIA, it is supported by good fundamentals. You see the growth rate, 100, 200, it's crazy. And I'll just share with you a conversation I had with one of the NVIDIA investors earlier ones. So he was saying why is he so bullish, right? In one of the previous quarter, he said that they are already telegraphing this new Blackwell chip. I don't know if you follow, but it's a new type or new form of whether it's a H100. It's a different iteration. So this chip is not even done. And he said he's already seeing billions of revenue. So the revenue haven't even counted yet. So today, let's say I'm doing 100 billion. I'm telling you that by introducing a new chip, I'm basically booked out for the next
People
3-4 quarters.
Reserving it, right?
Yeah, exactly. So the amount of money just pouring in is crazy. And
before it's launched.
Yeah. It's not even there yet. Exactly. So how do you do a projection? It's inconceivable for you to do a projection unless you really can see into the future. So that's why it's always very tricky to look into these kind of growth companies and tell people that, oh, it's expensive or it's cheap now or whatnot. So I think it's really in this phase where there's a lot of discovery. There's a lot of price discovery. So like I shared, right? The market is trying to discover the prices. So we're not there yet. We don't know. There's a very big range of possibility, but I do think that, or at least I am hopeful, or I do think NVIDIA is probably going to be one of the bigger winners. But when you look at it on a net basis, right, I think I came across this point where they say more than 100% of the profits are earned by NVIDIA in this whole AI boom, meaning everyone else is just losing money. Your Amazon, your hyperscalers, right? Amazon, Google, all those cloud business, they buy a lot. Are they able to monetize it effectively? I think it still remains a very big question. Hopefully they can, because I'm an investor as well. But now the mentality is really, I buy first, I think later. Because I rather over-invest than to under-invest and lose to my competitors. So this is the very big, crucial point here. When does it break? If it doesn't break, if all these people just keep spending money, NVIDIA wouldn't break. Because you want to be logical, right? NVIDIA keeps growing like that. Of course, you're willing to pay a much higher multiple and a much higher price. Because they can prove. They can tell you that I'm earning X amount of dollars. They can tell you that I'm buying back shares. They can tell you that I'm giving you dividends. So what is not to love about the company? So really now the biggest query or the concern here is out into 2 years. 1 year, they have visibility, meaning they always have future orders that booked in. But what happens in 26, 27, 28? I think that's really the demand and supply law, how people try to determine and price discover how much this enterprise is actually worth. But in the short term, I don't see lah. Regardless whether recession or not, right? all these companies are still gonna block out all the orders from NVIDIA. The three biggest one, I think they all just booked out everything. Yeah, so NVIDIA is just printing money, and there is no worries lah for now in the short term. That's my perspective.
Do you spend a lot of time like understanding about this AI companies?
I try to. I think you can't, because I'm in a financial education company, so a lot of people are asking a lot of questions every day, and I'm creating content as well to know what people want to know. So I need to be plugged into the system. But if you ask me if privately before I start, actually I'm not so much into I was never every day open CNBC to watch Wall Street Journal. I was never that kind of guy. I was I do my own screening. I realized that this company is interesting. So bottom up, you try to look at the company first. Then you try to consider, or you layer in the macro, the interest rate and what.
Right.
Yeah, but I think over the years I've came to, I guess, be comfortable with this whole. It's a very tiring cycle to keep running.
How much time do you spend on research, like on a day-to-day basis?
A lot. I don't know. I don't keep track. I think it's
you just keep reading.
Work-life harmony. Right. If you really enjoy what you're doing, I don't think I don't think it's work lah. So if you talk about research, I don't know. I don't keep track. Yeah.
And like when you go and meet friends your age at 26, how do they see you? It's like
that's why I don't really meet friends my age, if I can.
Okay.
I think bluntly speaking, right?
It's like they'll see you as this like guru, right? Talking about stocks.
Not really. I try, actually, in fact, people that are close to me or people that know me, even my partner's relatives and whatever, right, I try to always stay away from talking about stocks. Because
from your work, you just talk about other stuff.
Yes, I talk about other stuff.
Why do you want to do that?
And so on a YouTube platform, because you have discovery, you have the algorithm, I already know that when you come in, you are probably already interested in stocks. But for a lot of people in real life, right, they're not. They just want the next
They might not even know
10x.
that you're on YouTube.
Yeah. I think they do, but they might not. They don't support lah. Actually, even my mom doesn't watch my content.
Okay.
Yeah. So
are you sad?
Last time maybe initially yes, but I've gotten over it because it's just a difference in interest lah.
Okay.
Yeah, but back to the point, right, on why I try to refrain, right, is because a lot of people get into investing or get into equities, right, not knowing what the risks are. But when I go onto YouTube, I find my own tribe or find the algorithm will recommend you. If you can chance upon my video through a recommendation, right, means that you already trained the algorithm to know that you like investing related content. So you probably already have dabbled into it. You know about the risk and whatnot. Right. You know that this is not a bao jia, means sure win kind of thing. The worry about a lot of the laymen that I meet in real life is they always want sure win, meaning, oh, this stock can buy, can 10x, can 5x, I want to grow my money.
They want quick answers.
Correct. So that's when I start to get worried and I can't promise anything. Because like you think about it, even if the stock 2x, 5x today from here, you're not going to give me anything. But if the stock gonna go down, right, 20, 30%, you're gonna blame me. You're gonna say, yeah, stupid lah. You're not gonna, your research is fake, blah, blah, blah. But we need to understand it's always a range of outcome. I can't tell you for sure what's gonna happen. So yeah, in the grander scheme of things, that's why I tend to not share. But I think in my immediate closer friends, those that I spend more time with, usually people older than me. It's not necessarily my same age group of friends. Actually, my girlfriend calls me an uncle as well. I'm very uncle in the way I'm thinking. Yes, correct. Right. Yeah.
So like now you're 26. What's your plan towards 30?
What's my plan towards 30?
Yeah. Like your investment plan or your personal financial plan.
Hopefully it plays out. As in, hopefully the thesis plays out and I continue contributing to my portfolio. Let's see. I can break. I don't know.
What's the goal of a portfolio?
At the end of the day, I think it's just there's this term, right, in personal finance they call FI money, which is financial independence. You want there's this another term which is FIRE, right, financial independence retire early. I'm not very interested in the retire early part, but I think the financial independence part gives you that baseline confidence that you're not really afraid of whether you lose your job, the economy is bad and stuff. So that is the first stage of, I guess, financial independence.
How much is that?
To me, if I don't count anything else, just my own personal expense is probably closer to 1.2. 1.2. That's the number that I crunched.
That is the FI money.
I call it the FU money. but it's the same logic, right?
Yes.
Yeah.
Right.
Yeah.
Is that for your family, nucleus, or just for yourself?
Just for myself.
So if you get married, then it's like 2.4.
Yes.
Okay.
No, I think But I think if you get married, expenses can be lowered, right? Because you share stuff and whatnot.
Or you can increase as well. Like,
you can, exactly. You can increase as well.
Okay, so what will you do with 1.2 once you hit that? How does that 1.2 play out into that freedom thing? Like, will you start to roll into dividends?
No, I think it's still in business as usual. I think it's similar when I crossed that 6-figure mark, right? Nothing changed because everybody said, oh, you need to hit 6-figure by whatever age, you get more comfortable, get more confident. I think habits are being built along the way that are good habits. And I don't think it'll be like, oh, you hit X amount of dollars and then you suddenly become enlightened and think that, oh, you achieve a nirvana. I don't think so. I think you need to be more comfortable with the fact that what you're going to do after that. And to me, I'm not interested in the RE part. It's just that I can tell myself I'm accountable to myself that, okay, today you have hit X amount of the threshold that you want. Let's say you set it at 1.2.
Right.
After 1.2, just means that you are more comfortable than normal, and then you can spend more time to do other things that you like. Not necessarily means that you quit your job, go and travel the world and whatnot. Because maybe it's not enough. To some, it's a lot of money, to some it's not. But to spend it frivolously, especially when you're younger, I think that there's a certain risk there. So if you retire at 1.2 today at 65 versus let's say I hit it at, I don't know, 35, 40 years old, there's difference because you have 20, 30 years of extra years you need to account for. Yeah, but in terms of portfolio allocation perspective, if I'm still working, I don't think I'll switch the strategy. I think converting over to dividends is really I'm ready to retire already. Meaning I really want to get passive income. But if I'm still generating income and doing my research and whatnot, then I'll continue my race until the day that I really cannot take it, or my body cannot take it.
So how much percentage of your like income from your main gig, right? Do you pump into like your portfolio?
Meaning my full-time job, right?
Yeah, like 60%,
I don't know, is this
70%.
I don't know, is this like
it's like, okay,
extreme?
Oh, okay. I mean, like we're just trying to understand, like, from a young person point of view, right? I mean, like, a lot of our audiences are also like maybe in the workforce, professionals,
right.
and all that. Like usually, what do you advocate personally, like your own preference?
I saw this table before. So actually, this table actually describes the idea of share buyback. So it's an investing concept. Basically, the magic comes in when you are at 80%. So if you think about it, right, let's say the company today is worth $10. So if it buybacks $5 worth of its share, meaning you divide by 2. So 50%, your valuation should double, assuming everything ceteris paribus. But the magic really comes in when you go down to 70%. When the company buys back 70%, 80% of the shares, then you will see that 10 times, 5 times, 10 times impact. And then if you just extrapolate out, right, if you save 90%, that means a 10x of the valuation. So might not be very relevant, but if you convert it back to like personal finance, right, it means that if you're able to really save 80-90% of your income, actually you reach financial independence very, very quick. Because it means that you can survive with 10% of your let's say your expenses is only 10%. I think the general rule of thumb in Singapore is probably try to save and invest 20-40%. For myself, I might be a bit extreme because
you spend very little.
Yeah, I think through the course, I spend very little, and I try to keep my expenses matching to my side income, meaning whatever I earn on, like whether it's sponsorships, AdSense and YouTube and whatnot,
you use that.
Those should cover. So I technically invest 100% of my active income now.
Right. Then you use your
main income,
personal side gig to settle your expenses.
To settle my expenses, correct.
Right.
Yeah.
And when was, you mentioned like your first stock was when you were like JC days?
My first stock was
with your dad?
Was even earlier than JC.
Right.
Yeah. Because I couldn't even buy the stock. As I was not of legal age.
And that was the time that you started?
I started, correct.
And you have been like investing since then?
Yes.
So perhaps that has been like probably about 8-9 years already.
But I don't really necessarily count because I don't make the investment decision. So when I started counting my real experience, it's only in Army year 2.
Right.
Army year 2. So before that is all my dad bought. I 顺便 tag along. It was a ride along. And he usually choose those blue chip that wouldn't go missing. So I just tag along 1 or 2 lot. That's all.
Right.
Yeah.
So are you able to project like the next 5 to 10 years? Like what are some of your business plans? Will you like maybe open an academy or like?
I think for now, no. I don't really have any specific. Actually, even for YouTube, right? I'm not running it as a business. It's really just that's why I'm not consistent or like I don't have open.
It's just more like
slots
a fun kind of thing.
Yeah, correct. I just like to share and I like to talk and people. I'm very happy or contented that people want to listen.
Right.
Yeah, so in terms of business plans wise, not so much now. Maybe in the future, I think I won't be against the idea, but I'm just sharing along the ways, and I guess brands are subsidizing my lifestyles right now.
Okay.
Yeah.
Maybe one final question is that what advice will you give somebody that's the same age as you?
If it's my age, meaning 26, right? I think you should go and try it out first. Don't delay. Don't keep thinking that you don't have enough money. Now fractional trading, even you put $1,000, also can trade. Go and experience the perspective of losing money, the volatility, see how your emotions gyrate together with the markets, and then find an investment methodology or philosophy that fits you. I think it's more important that fits you rather than people say value investing is the best, momentum, growth, whatever. I don't think there's a best strategy, but it's important enough for you very early on to figure it out first so that you can stick through it. Because I've came to realize a lot of people that conversed with me and chatted with me, the idea that they keep switching. So they started with value investing, then value investing hasn't been performing well. The traditional value investing hasn't been performing well for the last, I think, 5-10 years. Then they switch over to growth investing. Then in 2022, the interest rate, everything crashed. They lost 60-70% again. Then they start switching again to, I don't know what's the next in thing. So when you're young, you can do that kind of experimentation. Right. But I think when you're older, it gets very dangerous because you have mouth to feed, you have family to take care of and stuff. Yeah. So to try things out first, never say never. But after you try, I think you need to always be in this reflection state fast. You need to reflect and to understand your risk profile, your personality, how everything fits into your own projection and your life. And unless you really love the game, which is like me, I don't know whether I can share my passion, but I do know of a lot of people that are not interested. So even if you're not interested, you should still get your feet dirty, whether it's through passive investing, index funds, ETFs, whatever. Get in first, then we talk about it. A lot of people like to say it's contrary to popular belief because a lot of people say you want to swim, you need to go and learn swimming first. You want to drive, you need to get a license first. I think that's important on the knowledge front, but it's also different when you really think about it. When you learn theory, right? You read 10 books on swimming, I can tell you still won't know how to swim. You can be the best well-read person, but if you don't get your feet dirty, right, it won't amount to much.
Right.
Yeah. So that's the important part there. Yeah.
Awesome. Right. Okay. So it's time for candle cards. Just pick one.
Okay.
Purple is personal. Blue is work. Yeah, you can choose one. Okay. Let's read out the question for.
Do I read it out?
Yes.
What is one thing you would do if time and money wasn't a factor? Actually, I think I'll still continue doing what I'm doing. I think I'm getting a lot of enjoyment and contentment from what I've currently been doing. But maybe less so in terms of the time put in. Maybe I'll chill a bit more if time and money wasn't really a concern. Because at the end of the day, we still are pragmatic, right? But if you look at it, like the genre of types of things that I do, I'll probably still do the same thing. Yeah, but at different intensities and different ways that I'm doing it.
So no regrets going into the
No.
equity investing field.
No. I think people around me, whether it's my parents or even my friends or people that I talk to, they can probably see that it's
something that you really enjoy.
That I really enjoy, yes.
Awesome. Great. Thanks, Chi Keng, for coming on our podcast.
Thanks,
good to have you. I think that you have such a young, bright mind, and there's like perhaps through years of like really reading, understanding, researching and all that. Yeah. Thank you so much for sharing with our audience.
Thanks for letting me come here. I underwent this sort of propaganda phase since young. My dad was just telling me that, you must invest. Sure. Can.
Oh, okay, great. All right.
Okay.
Yeah, sorry again.
Testing.